Weyerhaeuser? I don't know how to say this. It's Austrian? I speak English. I don't know what this is. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of April 26th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Back-to-back green weeks doth mine eyes deceive me. Yeah, we had some hiccups there, including a terrible, horrible, no good, awful, rotten day on Tuesday, and then Thursday, President Biden said some stuff about capital gains taxes that apparently made everybody sell off, even though it's totally expected with this administration. Whatever. Other than that, we did finish on a very positive net note on the week across all four of the major indices, and it's looking pretty good heading into next week. Most of you guys, if you're following me, you might have small cap portfolios or small cap trading portfolios like I do, and you should have actually seen money start flowing into those small caps. At the very least, they should have kind of bottomed, the drop should have stabilized, and some of them should have started rising again. So really great to see. I'm very happy about it. Let's get started with the news. If you're new to the channel, just a reminder, I do share my TA every single week. This is my practice that I'm sharing with you guys. The link is going to be below the video if you're interested in checking it out. First news story, let's talk about what President Biden was doing with the tax, just kind of clarify some of the issues surrounding the situation. But this was the negative story that the market reacted so strongly to at the end of trading on Thursday. Increasing the capital gains tax, penalizing initiative, enterprise, and not just the rich. So this is a little bit of an opinion piece. I'm not going to get into that part of it, but I am going to talk about what the actual tax initiative was. Mr. Biden will propose several tax increases he included in his campaign's Build Back Better agenda. Starts with raising the top marginal income tax rate to 39.6% from 37%, which is the amount that it was cut to by Trump in 2017. Biden would also raise taxes on capital gains, the proceeds of selling an asset like a stock or a boat, for people earning more than $1 million, effectively increasing the rate they pay on that income to 39.6% from 20%. So that capital gains tax on high earners is actually going to be a staggering increase. It's effectively doubling, going from 20 to 39.6. Now I know not everybody is a high income earner, but those people just got a huge hit. This kind of makes them less likely to get in and out of short-term trades, in my mind. Administration officials were debating other possible tax increases that could be included in the plan this week, capping deductions for wealthy taxpayers or increasing the real estate tax on wealthy heirs. All of the tax provisions would keep with Mr. Biden's campaign promise not to raise taxes on individuals or households earning less than $400,000 a year. That last part is really important to remember. This is really only affecting wealthy earners directly. People earning less than $400,000 a year are not going to be taxed at any increased level, but wealthy earners will be taxed higher. Now, there's arguments from a philosophical economics perspective on whether or not this is going to have a greater impact on the market. There's two sides to that argument, but immediately the direct impact is just going to be on wealthy earners. And also it talks about how state taxes are added on top of this. So in states with high taxes like New York and California, we could actually see a continued exodus of wealthy individuals from those states, leaving towards lower tax states like the American South and Southeast. We have started to see this in Texas especially, where a lot of Californians are moving to Texas to avoid the tax situation in California. Next news story. Netflix misses Q1 subscriber targets, blaming COVID-19 issues, but it beats financial forecasts. When things don't go in your favor, blame COVID. No, but seriously, I do understand it this time. They're saying that at the start of COVID last year, they had a huge influx of new subscriptions, and as things have kind of returned to normal, just some of those subscriptions weren't renewed, and the content was also very light in the first quarter on the platform. Even though the knee-jerk reaction here is just be like, oh, blame COVID. Okay, yeah, I kind of get it. I kind of get it. Net cash from operations surged to $777 million in the quarter from $260 million, and free cash flow of $692 million was up from $162 million. It's on track to free cash flow break even this year and doesn't need outside funding anymore to fund day-to-day business. That's actually huge. Netflix reported 208 million global subscribers at the end of the first quarter, missing its own prediction of 200 $210 million, and the streaming giant did beat financial targets, though with earnings per share of $3.75 coming in ahead of Wall Street's analysts' expectations. Revenue of $7.16 billion also topped the street. So earnings per share were up, revenue was up, subscriptions were down substantially, even missing Netflix's own internal predictions. What did this do to the share price? If we go into Webull, you can actually just glance at the chart and see right when the earnings happened. The day before earnings were released, we closed at $549.57. The next day we opened at $508. So this was really like what, a 9-10% decrease overnight off earnings, but there was also a strong green high volume candle here, so people did kind of buy the dip. Currently Netflix is trading at $505 a share. Missing the subscription numbers ended up leading to them losing like around 9 or 10% of their per share value, even though the revenue was up, the EPS was up. I mentioned a couple weeks ago that I canceled my Netflix subscription. I just wasn't enjoying the content on it anymore, especially with most of what I enjoyed moving to Disney Plus with the Marvel content and the Star Wars content. So I'm one of the people that kind of jumped off of the Netflix wagon in the last quarter, but I'm happy that the revenue and EPS was a beat, and I still think this is a solid investment, and this reaction was probably a little unwarranted, and I would expect Netflix to rise back up to those pre-earnings report numbers relatively soon. Discord walked away from Microsoft talks, may pursue an IPO. Why not pursue an IPO? Everybody else does it, and then your company gets extremely overvalued right away, and you make a ton of money. Microsoft probably wasn't offering Discord enough money compared to what Discord realized it could get off IPO when it looks at some of these other ridiculous IPO valuations that we've had in the last couple of years. So a month after reports that Microsoft sought to buy the hot voice chat app Discord surfaced, the talks are off. A source familiar with the deal confirmed. Discord is considering plans to stay independent, possibly charting a path to its own IPO in the not too distant future. The two companies were deep in acquisition talks that valued Discord at around $10 billion before Discord walked away. Knowing how many instances of Discord are downloaded right now, how many users Discord has, $10 billion seems like a lot of money initially, but when you compare that with other recent IPOs, actually I really think Discord was insulted by Microsoft's valuation attempt, and they think they could do much better on their own. If they decide for a buyout, if they decide to opt for a buyout, they could always do so at a later date after they go public. That happens all the time. But for now, that's the avenue they're going to pursue to grow their business. Discord's valuation doubled in less than 6 months last year, and its stock is only looking hotter in 2021. I think that might be why Microsoft kind of lowballed the estimate. They saw the valuation double despite very little material gain being added to the platform, aside from probably temporary new users through the pandemic. I don't fault either party here. I applaud Discord for trying to get that money, but I also applaud Microsoft for not chasing. That's some responsible business management investing right there. Intel's earnings came out. Intel's new CEO, Pat Gelsinger, said Mobileye had its best quarter ever. Rocket Lake and Ice Lake are launched. Tiger Lake is ahead of schedule by about 6 months. We talked on this channel about their foundry services, their chip making, and the fact they're investing, I think, $20 billion into making a foundry. They're already in talks with potential customers right now. Quarter one of 2021 had the highest PC sales in history, up 30%. Intel's 10 nanometer process is to take over for its 14 nanometer process in volume in the second half of 2021. This sounds good, but Intel's been on 14 for a really long time, when Nvidia and AMD have been working on like the 7 nanometer process, working towards the 3 and the 5. So the fact that Intel is just going from 14 to 10, of course, progress is better than no progress, but they're lagging behind. They also did say that the 7 nanometer process is progressing as well. Regarding the financials, their quarter one 2021 revenue exceeded guidance by $1.1 billion. Yay! But it's still flat year on year. Gross margin is down 6% year on year. EPS exceeded guidance by a lot, $1.39 versus $1.10 predicted, but that's still down 1% year on year. They have a lot of free cash flow, and they did just complete a $2.4 billion stock repurchase purchase program. Their guidance was also down year on year for basically everything: revenue, margin, EPS, and they have the $20 billion cap hit for their new foundry investment. All in all, the current quarter was pretty good. Revenue and EPS beat guidance, EPS killed guidance, but their 2021 outlook is effectively flat to negative. So the stock ended up taking a dump on this, as you would imagine, because even though one quarter is nice, the next year they're basically predicting almost no financial growth. If we look at the chart, right away you can see where the earnings report was released on Friday. We closed on Thursday at 62.57 and we opened on Friday at 59.16. We hit a low of 57.90. This was a 5% drop just off that earnings report. Two other things worth noting: stock buybacks are lower from now on. More investments are going to go into the business. Now, some people think that's a negative, that they're going to slow down the stock buybacks, but they need to invest into the business to catch back up to AMD, to Nvidia, to make sure their foundries are on the same level as Taiwan Semiconductors. Also, as kind of a balance to cutting the stock buyback program, they're committing to growing their dividends. If we go to the Intel website, we can see their dividend history. Their dividend percent, according to Webull, is about 2.22%. So they're going to be growing that percent. This is going to be an effort to make people buy the stock and hold the stock. I think this dividend increase is a tactical move to make sure that people don't sell the stock before the foundry comes online. Intel's chip foundry, Intel's semiconductor foundry, is going to be a huge investment for the company, a $20 billion investment. And this is going to be necessary, especially with all the bottlenecks we've seen in semiconductor production. However, the foundry is not going to be online for over a year, I think 2 years. So the company needs to incentivize shareholders to keep holding. One way to do that is by growing the dividend. Now, just a moment ago, I said cutting the stock buyback isn't really a huge deal. Let me show you why. In 2021, quarter one, this is in millions, by the way, so $2.4 billion was spent on purchasing back 39.5 million shares. Why does this actually not matter? The float is 4.03 billion. So buying back 39.5 million shares is quite literally a drop in the bucket. It doesn't much matter, and the company spent billions of dollars to do that. I'm in agreement with them that their capital can be more appropriately spent elsewhere, including business development to catch up to Nvidia and AMD, and including increasing the dividend. When I was looking at this on FinViz, Intel is a semiconductor company. Their PE ratio is incredibly low at 12. Forward PE is 13. Their price to sales is 3.2. Their price to book is 3. All of these numbers are really, really low. And I realized this and I wanted to compare them to some of the competitors. Taiwan Semiconductor Manufacturing, PE of 32. Forward PE of 26. Price per sales of 11. Price per book of 9.3. Go to AMD. Even more. PE is 40.5. Forward PE 32.7. Price to sales 9.8. Price to book 17. Nvidia. PE is 88.66. Forward PE is 40. Price to sales 22. Price to book 24. Now, I understand that Intel is not a direct analog to TSM, Nvidia, AMD. I understand Nvidia is dealing with AI. I understand that AMD has better chips right now than Intel. I understand that TSM is a more established foundry than Intel, and Intel's foundry is still 2 years away. But the valuation for Intel right now is shockingly low. So low that I think I might actually open a position in Intel and start adding to it over the next couple years until the foundry finishes. Now, I realize this is a bit of a leap of faith because their process is way behind AMD's and Nvidia's, but with the foundry, they're going to be securing additional income. And also on the earnings call, they mentioned shifting some of their production and their capabilities into dealing with the vehicle semiconductor shortage that's been gripping the nation and the world. So I'm not 100% yet, and I think Intel is going to drop a little bit more, but this is going to be something that I'm watching. I did not realize the valuation was that attractive for the company. Next up, I don't want to brag, but you guys remember when I talked about buying puts on Kimberly-Clark? Cha-ching. I ended up getting like plus 250%, and I even played that really conservative. The earnings report was worse than expected, worse than I even imagined. Kimberly-Clark posted quarter one adjusted earnings Friday of $1.80 per share, down from $2.13 per share. Net sales were $4.7 billion, down from $5 billion. This is net sales, so this is counting starting materials increase. The company said the quarter one comparisons were affected by COVID-19 related stock up a year ago period and the temporary supply chain disruptions related to severe weather conditions in the southern part of the US. This is the big one. Organic sales growth for the year is now expected to be between 0% and 1% from 1 to 2. So the company adjusted their projected EPS down significantly, and they're projecting 0 to 1% growth on sales for the year with decreased net income. The raw materials costs are killing them, as I expected. If we go into the chart on Kimberly-Clark, I don't know if you guys follow me on Twitter, but I kind of tweeted about this. You know, I bought the puts Monday morning at the beginning of the day, and it opened at 139. What happened that day? It ended up closing at 142, so my puts lost like 50% value. The next day, it ended up going up to like 143. At this point, I was like, ugh, okay, I'm done. It's over, whatever. I still had my thesis though, so I didn't close out the put. And then I was rewarded. The next 2 days, the stock price just tanked. On Friday, I then ended up closing at 132. So I had a lot of you guys tweet at me, hit me on Instagram, on YouTube, talking about your positions and all the gains that you made. Awesome. Congratulations. Happy for you guys. I'm pretty happy with this one too. Amazing what a little bit of research does. Also, another earnings report that I was very interested in last week, Cleveland-Cliffs reported its first quarter results. The first quarter consolidated revenues were $4 billion compared to the prior year first quarter revenues of $359 million. Year on year, $359 million to $4 billion. That's more than a 10x. That's incredible. For the first quarter, the company recorded a net income of $41 million or 7 cents per diluted share. And the company released its full year EBITDA guidance to approximately $4 billion, which is up $500 million from its previous guidance of approximately $3.5 million. This revision is based on contract renewals and the increase in steel price. The steel price is obviously helping the company, but also they're solidifying their business by getting repeat customers through contract renewals. If you go through and read the transcript for the earnings report, the CEO, who is hilarious by the way, basically dumped on all of the analysts for not knowing how to value the company. He repeatedly said the company is going to be using all of this extra money that they suddenly have, not to expand operations, but to pay down debt. In a cyclical industry like steel, where the prices rise and fall dramatically, paying off your debt and going debt free when steel prices are high is absolutely incredible. Because last year, Cleveland-Cliffs expanded by purchasing out ArcelorMittal's American locations. So Cleveland-Cliffs already did its necessary expansion and it brought all of those up to speed. So now it's just going to be paying down its debt to prepare for the next downturn in steel prices. So it's going to increase its credit rating as a company, and should it ever need to borrow again in the future, it's going to have a much more favorable borrowing rate. I was reading that a lot of Cleveland-Cliffs debt right now is like 5 to 6%. That's really high for a corporation. So if they can increase their credit rating by paying down their debt with all of this cash, they're setting themselves up for a much better future. This company is looking better and better and better, not just as a short-term investment, but as a long-term investment. The CEO also said, with our leadership position in the industry, we're focused on profitability as we are on the environmental stewardship and on supporting good-paying middle-class union jobs. Our commitment to reduce our environmental footprint will only further strengthen America's position as the cleanest steelmaking country among the major steel-producing nations. As a country responsible for just 2% of the global steel industry's GHG emissions, the United States has the right to produce steel and manufacture in America instead of importing steel and allowing foreign polluting countries to export their full employment at the expense of the American worker. That sounds like a speech that was literally directed at the President of the United States. Like, hey, check us out. American worker, good paying union jobs, environmentally friendly impact, less pollution than imported steel. I mean, if that's not an appeal to the government purchasing the steel from Cleveland-Cliffs for all of the infrastructure plans, I don't know what is. Let's take a look at the upcoming earnings for this week. This is the busiest week of the quarter. We've got the rest of our FANG stocks after Netflix. Apple, Amazon, Netflix was last week, Microsoft, Facebook, Google, Tesla. I mean, this is all the big names. Visa is reporting this week, McDonald's, Twitter, Neo, if you're into that. Really, really exciting. I mean, this is the kind of earnings week where you just sit at your computer every day, refreshing Yahoo Finance and looking for interesting trends. Of course, you're going to see stuff like AMD and Ford Motor Company. Ford Motor Company is going to be reporting about the semiconductor shortage. AMD is probably going to be reporting semiconductor backlog. I want to take a closer look at FireEye this week, as well as Weyerhaeuser. I don't know how to say this. It's Austrian? I speak English. I don't know what this is. So I want to take a look at these two companies. Also, if you're a Sensonics investor, you might want to focus on the earnings report for Dexcom this week. Just take a look at the growth for their CGM. Let's start out with FireEye. I talked about FireEye at the end of last year. FireEye is the company that made public the SolarWinds hack. Russia hacked Microsoft through some SolarWinds products, and it was a big deal. FireEye ended up coming out and revealing the hack to everybody. The public's knee-jerk reaction was to blame FireEye for getting hacked because they ended up sharing all of the information on GitHub so that all the other companies could protect themselves. And a couple days later, it was realized that what FireEye did was actually heroic, and it was the morally upstanding thing to do. And at that point, FireEye's share price went up significantly. Now, you could see when the hack was announced, that was, I believe, right here, December 8th into the 9th, and the company ended up losing a significant amount of value. But then it was made public, the information that the company actually found the hack and alerted everybody, and the share price ended up going from $15 up to a high of $25.50. And this was a 67% increase over the course of a week. We're currently sitting at about $20.28. This could actually go one of two ways, and I'm very interested in playing it. The company had a dump on its last earnings, a high volume dump, and you can see it right here. And the reason for that is that they're really not making money. They had a revenue gain of $247 million, but their net income was negative 38.6. So the revenue was increasing, but the net income was still down. They are not a profitable company as of the last earnings report. Now, I want to play this, but I'm actually not sure which way it's going to go. The increase in per share price for FireEye is directly correlated to the fact that they revealed this hack back in December. The excitement from that might be wearing off, and what we could see is that the company reports their earnings, the earnings are disappointing, and people dump the stock realizing this isn't a profitable company, or this is their first quarter with a full 3 months since they uncovered that SolarWinds hack, and they have all of these new clients flooding in, using their services, paying them for consulting services, paying their techs, and they just have backlog business, in which case they're going to report an earnings beat. Also in support of that, they were pretty close to being profitable last quarter. So maybe this is the quarter where they finally turn profitable. So what do? I really want to play options on this because I've been following this situation for months now. If you're not sure how to invest in a stock that you have a strong suspicion is about to move very strongly in one way or the other, you're not sure if it's going to be positive or negative, one thing you can do is play an options straddle. Now, what is a straddle? A straddle is a neutral option strategy that involves simultaneously buying both a put option and a call option for the underlying security with the same strike price and the same expiration date. A trader will profit from a long straddle when the price of the security rises or falls from the strike price by an amount more than the cost of the premium paid. Potential profit is virtually unlimited, so as long as the price of the underlying security moves very sharply. The current share price is $20.27. I'm going to be buying calls and buying puts for May 7th, and I'm thinking of doing the $20 strike price on FireEye. Now, when you do the straddle, the idea is that it's going to be a very volatile move. So I'm not sure if it's going to be volatile to the positive side, volatile to the negative side, but I do strongly believe it's going to go one of those two ways. So I am going to open up the straddle here. The last options play for the week. This is a really exciting one. Weyerhaeuser? I'm going to say Weyerhaeuser. They're a timber and lumber and real estate business, and they operate as a REIT. They sell lumber. We already know lumber prices are really high. I want to drop some more knowledge bombs on you guys really quickly. Now, this is their map. They have 11 million acres owned in the US. I want you to notice where these acres are. This is all in the US South, which is country for US yellow pine. That's their most common tree in this area. They also have some territories in Canada and the Northwest and around the Great Lakes over here. Now, they focus on being green, blah, blah, blah. That's not really important for the option. We don't care about the environment. We just care about making money. 7 million acres in the South. Now, in the South, they sell premium southern yellow pine. Right now, it is important to note that log and lumber prices, so timber and lumber, are not directly correlated. So we've had lumber prices going up. We know this. We talked about the RFP option a couple weeks ago. Lumber prices are driven by housing starts starts and lumber inventory. Log prices are driven by supply of logs and demand from mills. Now we know we have demand from mills. What about the supply of logs? Wet weather is driving southern timber prices higher in the first quarter of 2021. We had a lot of rain, we had some blizzards that went very far south, a lot of wet weather. This caused bad situations for the quality of the timber. So the price of timber is higher to make sure you get good quality timber. And you can see here the price sharply rising for timber in January going into February. Guess what kind of timber is most in demand in the South? Southern yellow pine, which just happens to be the type of timber that Weyerhaeuser produces. Southern timberland owners face increasing pressures. Population growth in the U.S. South has exploded over the last few decades, with new homes, new properties being purchased. And look at the map. Again, this is the same exact geographic area. Why am I even talking about this? Because Weyerhaeuser operates as a REIT. REITs are valued based on the real estate value of their properties primarily. So Weyerhaeuser is going to have increasing property value of its timberlands just because of developments surrounding the timberlands in the American South. We know that housing developments are skyrocketing, that new houses are being built everywhere, so it stands to reason that Weyerhaeuser is going to have an increase in capital from lumber sales, which it does, from timber sales from the southern yellow pines, and from its actual property value. Let's go into Webull and take a look at the chart for Weyerhaeuser. The low price in the COVID drop was about $13, and it actually hit an all-time high last week of about $39.79. So we've had really consistent growth over the last year, but one risk factor on this is that they are close to an all-time high. The PE is getting a little bit high right now. So what am I going to do here? Because the PE is getting a little high, we're already close to an all-time high. I'm not going to go crazy with like lotto picks and buy some way out of the money calls, but I am going to buy some in the money calls. Right now I'm looking at the end of May for an expiration, and I'll probably be buying the $38 calls. Again, this is risky because the valuation is already pretty high for the company, but I really think this earnings report is going to be stellar for all of the reasons that I just mentioned. So, as with any options play, it carries risk. If you're wrong, you lose everything. If you're right, you gain everything. Hope you guys enjoyed the video this week. I am still scheduled to go and record my MTN interview in Seoul on May 3rd. So as soon as that one comes out, I'll be sharing the video link with you guys on YouTube. Also, I am doing a DD video this week. Yay, hooray! This video is going to be coming out sometime on Monday. I'm not going to restrict myself to 9:45 because it's actually not very time sensitive. I'm not going to say what the company is, but I'll give you a hint. As long as I get this video out before Tuesday, and you guys watch it before Tuesday, everything's gonna be okay. If you're new to investing and you want to support the channel, check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Because I'm partnered with Webull, the stock that I'll be getting is worth $60 or higher. As always, if you're enjoying the content on the channel, please like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. See you next time.